Let's do a quick mic check, sound check. If you could hear me, let me know. All right. This shouldn't take too long, guys. Just wanted to go over a couple of trade ideas for earnings. Again, earnings is one of those things that it's nothing but risk, right? So if earnings is not your risk appetite trade, if you don't want to stay up until tomorrow morning, looking at futures, looking at stocks trading in after hours, tick by tick, completely ignored. But if you are joining us, it's okay to look at some trade ideas and try to get the process that we use, or at least try to understand the thought process that I use to look at different trade ideas. First thing I want to do is I want to take a look at. I have just a few positions on. So one of them is this is a SPX unbalanced put condor, right? This trade has been open for about 31 days. S&P has moved about a half of one standard deviation. We had a bit of a drop off in implied volatility. Not much has happened since entry in this trade. You can see this trade was entered when SPX was trading at around 3,800. Today, S&P 500 is at 3,900. So we moved up slightly. Not much has happened. And this trade is currently, the credit for this trade was $2.15. It is currently showing a debit to close. If I was to close this out today, it's about 60-cent debit. I still have about 36 days left in this trade. So I'm going to do nothing for now and just kind of let it sit there. One potential idea is to see if I can buy back the 3,400. I'm short 3,450, 3,400. So this is a 50-point wide put credit spread. If I can buy it back and leave no upside risk and turn this into a sort of black swan hedge, that would be great. And this is what it would look like right now. If I was to close it out, I would pay about 260. So if I had collected 215 for this trade and I pay back $2.60, that leaves me with about 45 cents worth of risk. So there will be upside risk. There will be about $45 risk, but for $45 of risk, right, I'm getting a potential downside protection. And when I say downside protection, this isn't for a 1 or 2 day pullback. We are talking about, S&P would have to go down as much as 10% over the next 35 days for this hedge to kick in and pay off. Not a terrible way to turn this into a black swan hedge. Otherwise, I will just hold it a little bit longer, let some more of the time premium burn off, and essentially I can hold this until expiration. I can hold this for 35 days, and as long as the price remains above 35.50, this trade will eventually expire with all options out of the money, which means they will be all worth nothing. So I won't have to do anything to close out this trade. So just a couple of ideas there. Not going to do on anything on this trade right now. So, but I did want to bring this up and talk about it. Another piece I have left over, which is short Twitter put at 55 strike. Twitter had earnings. I put on a trade, which worked out well. Now I just have a leftover put that expires tomorrow. It's currently trading for just about 5 cents. So to free up capital, this put could be bought back for a nickel with no commissions. And the capital that is tied up currently in this trade could be used forward to initiate other trades. I'm just looking at a question. I see Vasily is asking, it will cost 200 because you're giving away the profit. I'm guessing this is about the hedge I was just talking about. So let's go back for a second. Am I giving up the profit here? So if I was to buy back, right, I had mentioned that I would consider closing, right? So this is my position and it's made of two spreads, right? I have a debit put spread and I have a put credit spread. So I have a 25 point wide put debit spread and I have a 50 wide put credit spread. And my put credit spread is down at 3450, 3400. If I was to buy back the 3450 and I was to sell off the 3400 put, right, essentially buying back the 50 wide put spread, I would be left with a position that looks like this. So yes, essentially, I would be potentially giving up all of the current profit that I have in this trade, plus an additional 5 cents or 55 cents, 50 cents maybe. But that is the cost of insurance, right? If I wanted to buy a debit spread at 35.50, 35.25, it would cost me a lot more than 55 cents. But because I've been in this trade for some time and I've had enough time to burn off some of the premium from the short put spread, now I could convert this into a hedge, which only put me at risk of about 45 cents out of pocket cost. So it's out of pocket cost plus whatever unrealized profit I have in this trade right now. So essentially, yes, I will be giving up all of the profit that I have in this trade right now, plus another 45 or 50 cents on top of that. But in exchange for that, I have massive protection against a 10% downturn in SPX 500 over the next 35 days. All right, does that make sense? All right, moving on. So we have the Twitter we talked about. Then I have two trades that I initiated, which is in MasterCard and in Chewy. Both are currently at a drawdown, which is totally fine. I mean, these are bull put spreads, so we don't necessarily need the price to go higher. We just don't need the price to move much slower. For now, they're both fine. You know, we may see the market up and down a little bit. Volatility may rise, and that will put a little bit of a pressure because the premiums will rise. And since we're short IV and we're positive delta, any downward movement with an increase in implied volatility will not work in our favor. But our goal is to, hold it maybe for a couple of days, probably by Tuesday of next week. We should be able to take off the trade in MasterCard, and Chewy has a little more time until expiration. Those are in February 26th expiration. So as long as the stock doesn't collapse on itself, it could go up, it could go down, it could go sideways. As long as it doesn't go down a lot, we should be in good shape there. And let's see. I'm just going to look at the list of companies that have earnings, and I'm going to take my notes. A couple of companies that I was interested in was Vasily says DDOG, DDOG. Yes. So let's go and look at some ideas. So the idea is, right, the first thing I want to look at is whether I am overall bullish or bearish or neutral, right? Which way am I leaning here? And then from there, I'm going to try to structure risk in a way that will come together with my directional outlook, at least for the near term. And again, an earnings trade will benefit if we're selling premium from a massive IV collapse. And this is what we're looking for. We're not looking for a massive move higher or a massive move lower. We're looking for IV crush, right? We're looking for premiums to come down, and we are going to try to structure our trade in a way that any move inside of an expected range should be in our favor. Now, if we get an outlier and if we get a move outside of what's expected, yes, there is risk. And I'm going to try to structure a trade in a way that my risk is only limited to one side, either upside or downside. Does that make sense? So, DDOG. Let's just look at what the price has done over the past couple of months, right? And again, what the stock did over the past couple of months means absolutely nothing when it comes to earnings. Okay, earnings is one of those binary events that could make you or break you. So if you're going to go all in on earnings, you can be the best technical analyst out there, look at the charts and the moving averages and whatever, but earnings is one thing, so we don't know what the reaction is going to be like. But overall, I think this is a fairly bullish looking chart, right? You could make the case for some sort of cup and handle, but I do see that the price is kind of pausing around the previous high, which was around 117, 118, and we're currently trading at about 117. So the buyers have recently pushed the price from about 100 to 115. So we saw about a 15% increase in the price. But now we're kind of pausing, and everything else looks fairly bullish. I think that if earnings are decent, no surprises, there's no reason not to expect the overall trend to continue. And the trend, I think, in my opinion, the trend is higher, right? You can look at, we've made lower high here, but we've made a higher low here. So it doesn't make it's more of a neutral trend, so to speak. But then recently, we started to make a series of higher highs and higher lows. So I think that the trend, immediate trend is up. Intermediate trend is probably sideways to neutral. So overall, I would lean bullish here. I want to structure my trade in a way that works with my neutral to slightly bullish outlook, right? So my idea, number one, so I'm going to use options that expire this week, since earnings are tonight. So we have options that expire in 1 day, right? We can see that earnings are tonight because implied volatility is at over 200%, right? We have a big skew in implied volatility. So we have options expiring this week at 200 IV, next week at 88. The week after that is at 74. So there's a lot of premium in the front month contracts. And if you are a net option seller and you are willing to structure trades in a way that you can handle the risk, this is a lot of premium that's available in options that are expiring this week and next week as well. I also do think that calendar spreads, they should do fairly well as long as we don't see a big move in either direction, or at least not more than what is currently being expected, because I do expect implied volatility to collapse regardless of the outcome. We're going to see premiums come in significantly. And you can check back tomorrow, looking back on Feb 12 and Feb 19. Look at the IVs that are available right now, and look back tomorrow, and you will see, if you're not sure what implied volatility crush means. So looking at a price of an at-the-money straddle will tell me more or less, what the marketplace is pricing in currently for earnings, or for the move after earnings tonight. And we can see that an at-the-money straddle right at 117 is where the stock is trading right now. We are at about, let's round this off to 10. And if you're not sure where I get 10 from, we add the price of an at-the-money call to the price of an at-the-money put. Current price is right at 997. So let's round this off to 10. So expected move is at 10. Is that clear? How I arrived at 10? So now I know that the market thinks that the stock is going to move up 10 or down 10 after earnings. So what I can do is I can say, all right, my goal is to set up a trade that is going to resemble, and Raghu, I'm going to answer your question. Yes, I want to sell premium on both sides. And I want to structure my risk in a way that I'm only, right, an iron condor will have risk on both sides. If we have a massive move to the upside, and by massive, I mean over 10, right? So a 15-point move tomorrow is going to be outside of an expected move. So I want to structure my risk in a way that a move in either direction outside of an expected range is only going to hurt on one side. So I want to set up a trade that only has risk on one side, either on the downside or on the upside. So if I am bullish, I want to assume risk on the downside with no risk to the upside. And if I'm bearish, I want to set up a trade that has no risk to the downside and risk to the upside. So what I'm going to do here, and I think this is going to make sense at some point, I'm going to look to sell. So for example, if I have a move to the upside of about 10, so from 117, the market thinks we're going to move up to 127. And if I am willing to bet that we're going to stay inside of that range, unfortunately, we don't have the 123, 124, or 126, 127. And so we only have single strikes up until 122, and then we have 125, and then we get $5 strikes. So let's just assume that I can, maybe I can do something like this. If I was to sell a 122 call and buy a 125 call, this would put me in a $3 wide call spread, right? I'm selling, so I'm a short this call spread. I'm taking in a premium of about 83 cents. My risk in this trade is $2.17. So I'm getting 83 cents and I'm risking $2.17. Now, what I need to do is now to eliminate. So what's my risk here? I take in 83 cents and I have to put up $2.17 with my broker to put this trade on, which means that I have at risk the $2.17, right? That's my risk on the upside, 217. To eliminate all of that risk, I need to sell a put. And I'm not going to do a put spread. I'm going to do a put. Well, you can do a put spread to keep margin in check, or we'll have a look at that and see which makes more sense. Okay. My goal is to sell a put that's going to cover my risk on the upside. So what's my risk on the upside? It's $2.17, $2.17, or $217 per one call credit spread, right? Because one contract or one spread is it covers 100 shares of stock. So 217 or $217 is my risk on the upside. I'm going to go and I'm going to look for a put that I can sell where I can collect $2 and at least 217 just to cover my upside risk. Right? So it looks like the 111 is currently going for about $2.47. So if I was to sell one of those, this is what my trade now looks like. So I have a short call spread, which is 3 points wide with about $217 worth of risk on the upside. And I am short one naked put at 111 strike. I'm collecting $2.43 for my short put. The premium I'm collecting for this put has more premium available to cover the max potential loss on my short call spread. So this leaves me with no upside risk, which means that if the company comes out with earnings and the numbers are great and outlook is bright and whatever, stock goes to 200, well, guess what? No upside risk. As a matter of fact, we're collecting let's just round this off, 245 from the short put. And my risk on the upside is, let's round this off to $2.20. I collect net credit in this trade. My risk on the upside is 245 minus 220, which is 25 cents. Worst case scenario on the upside, stock goes to 200, I'll make 25 cents. Times 100 shares, I'll make 25 bucks. Right? So no risk on the upside. The absolute best case scenario for this trade is that if the stock is inside of my short strikes, which is 111 on the short put, which is right here, and the 122 call, what happens is tomorrow, later in the day, right after the earnings, whatever happens, let's just say that stock goes to 120, it just stays there. So now what happens? We have 122, 125 call spread is decaying, which is good for us since we're short this call spread. We have the 111 decaying, which is good for us. Right? We're going to get to keep both premiums. Remember the what was it, 85 cents or from the short call spread plus 245 from the short put. We get to keep both. So that's the best case scenario, is that the stock tomorrow after earnings are out, right, we get this massive IV crush is what we're looking for. We get to keep premium from the short 111 put, and we get to keep the premium from the short 122, 125 call spread. Now let's talk about the real problem here. And the real problem is if the stock goes down. This is what no one really wants to think about. What happens if the stock goes down? Okay, because everything sounds great and everything looks awesome, and we're going to make all this money, and if I have a max potential upside here of 300, right? Who wants to make 300? I want to make 300 grand, so I'm going to just put on 1,000 of these, and not so fast. Okay, let's talk about the risk. What happens if you do 1,000 of these? What happens if the stock is at 80 tomorrow? Now, I'm not saying it's going to go there, but it could. Again, I'm not saying it's going to go there. We're not here to predict where the stock is going to go. We're here to try to limit our risk or trying to control our risk and set up trades in a way that we can handle our risk. What happens if the stock is at 80 tomorrow? We're going to have a short call spread that's going to be awesome. Full profit, whatever we collect for it, 80 cents, it's ours to keep. The real problem here is that our short 111 put is now deep in the money. Now, I know 80 is probably an extreme case, but what happens if we are in the money on our short put? Now we're facing the risk of A, getting long stock at 111, or B, we'll just have to exit for a loss and move on with ourselves and look for the next opportunity. Now, 111 is not necessarily our worst case scenario, because remember, we're selling a 111 put and we're selling a 122, 125 call spread. So this is going to give us a net credit of about $325. So we can subtract 325 from 111. Anybody want to do the math? 111 minus 3.25. Our downside break even is at 107.75. So if the stock is below 107.75 tomorrow on expiration, we are net negative on this trade. We own the stock at 111. We took in a credit of about $3.25 or $325 total, which will go towards reducing our cost from 111 down to 107.75. So unless you want to, or you would be willing to own the stock at 111, or your cost basis of about 107.75, if you're not okay with owning the stock at a cost base of 108 based on this chart, this trade is not for you. If you are okay with owning the stock at 108, which is right here, right around where the most recent resistance. Now, supposedly, it's going to become support. We don't know that. But if you're not willing to own the stock underneath 108, this trade is not for you. If you are okay with the idea that you might end up either taking a loss or taking the stock at a 108 cost, I think this is a good risk reward, or at least a good enough setup for earnings. Now, to put on this trade, we would need, if we did this in an IRA, we would need to come up with a whole bunch of money, right? If we did a cash secured, if we're selling a 111, we would need to come up with about $11,100 to put this trade on. Not everybody wants to do that, right? So what can we do to reduce? What can we do to reduce capital required to put this trade on? We can buy a wing on the downside to limit our downside exposure. And the only thing I can think of, unless you want to introduce risks to the upside, is since we have a net credit on the upside of about, I think we said 25 cents, we can spend this 25 cents or 20 cents to buy a wing on the downside. And it looks like if we buy a 96, put, this is going to cut our margin requirement from 11,100 to about $1,200. Right, so just about 10% of what was required before we bought this cheap out of the money put. Cheap in terms of low cost. This should leave no risks to the upside or make our upside break even, right? If we're collecting 20 cents net on the upside and we're spending this 20 cents to buy the wing, this leaves us at 0 on the upside. So if the stock goes to 200 and stays there tomorrow, well, we made nothing. If the stock goes down to 0 tomorrow, we're not out $11,100. We're only out about $1,200. So that's one way to do it if you wanted to do something like this in an account where you can't sell naked options, or you don't want to put up cash secured requirement to put on a trade like this. Again, the goal here is to capture some of the premium as long as the price does not move drastically to the downside. And again, if our expected move to the downside was 10 points, we're at 116 or 117 right now. 10 points to the downside will put us at 107. So if we move anywhere inside of expected move to the downside, we should be okay. Anything beyond that is a problem. And anything beyond 10 points to the upside should be okay. And if we move half of one expected move, right? So from 117, if we move 5 instead of 10, we're going to be in a really good place where we could potentially max out potential profit in this trade. All right, I'm going to take a breath. And if you guys have any questions, I think I covered all bases as far as what I look for when setting up trades like this. Vasily's asking, we can also roll put down and out. Yes, you can. The only problem with that is that if the stock moves lower, you're going to see implied volatility, not overall implied volatility in the chains for this specific company, but you're going to see implied volatility, right? Because there are plenty of the marketplace is out there selling this premium to somebody, right? Somebody's buying the premium, they're buying insurance protection, and the market makers, they're selling all this premium. What happens if the stock goes lower? All of a sudden, there's going to be a ton of demand for either further out of the money premium, right? Because anybody that's short the 111s and the stock goes down, let's say to 106 tomorrow, all of a sudden, people that want to get out of that trade, they will start to try to outbid each other to buy back those 111s. So the implied volatility for these options will skyrocket. And this will spill over into near strikes, right? So 109s, 108s, 107s are going to be stupid expensive. So for us to buy back the 111s and roll it out a week, the premiums, and I'm just talking about in IV terms, right? I'm not talking about in dollar terms. And a lot of times it translates and such, right? Which means you will not be able to roll out and down far enough. Maybe you'll be able to roll sideways and down slightly, but not too far down, because the premiums are going to explode to the downside and you're going to have to pay a lot more for the options that you're buying compared to the options that you're looking to sell. You will be able to roll down and out, but you will not be able to roll down far enough because the premiums in the front month are going to go through the roof. But yes, in general, you should be able to roll down and out and collect a net credit, or if you can do it for a scratch, I think it's a good bet. Unless, again, we just looked at the price and we think that there's an uptrend, or at least near-term uptrend. If the stock goes down below, and this is a pivot swing low for me, which is at around 96, right around here. So if we gap down underneath this 96 level, I'm not so sure that this trend, or maybe this trend goes from neutral to down. So that may become a problem. And because we only have 1 day until expiration, there's really not a whole lot we can do. So you really need to make a decision of, whether you're okay with owning stock at 108 or not. So that's one idea. Selling a 122, 125, and you can try to put something on like this. I wouldn't put this on early in a day of the earnings. I would wait until, get it as close as possible. Again, these are not always easy to fill in the last like 2 minutes. So don't wait until 2-minute warning and then try to push all your orders in, because a lot of times, look, we're trying to set up trades, right? We're net option sellers, and a lot of market making firms out there, they sell a lot of premium. So we're essentially competing for that business, and it's not going to be easy unless whoever's taking the other side of your trade is going to be able to hedge off some of that risk. And it's not going to be easy. So don't wait until last minute. You can start to look at, plan your trades ahead, and then in the last half hour, look around, start to put orders out there, see where you get fills, and so on and so forth. Don't wait until last 2 minutes to push your orders. You may not get filled. But so this is something that I would consider, selling a 3-point wide call spread and finance it with a short 111 put. If you don't have the margin, you can buy a wing to keep your risk down. And again, if we're inside, especially if you buy the wing, right? Think about it, you have $1,200 of risk. If the stocks is somewhere between 111 and 122, and you get to keep the $300 or whatever you may collect for it, if you think about it in terms of return on risk, you make $300 risking $1,200. That's close to 25% return on risk. I'm not saying go out, take out a loan, and bet it all on DDOG tonight, but if you have to do a lot of these, and you have to stay consistent. So that's one. Let me take a look at my notes. I know there's a number of companies out there. I'm not going to go through every single one of them. I'm going to only look at a few that I will consider taking. So DDOG is one of them. Another one is Disney. There was some news that I don't want to get into the news, but there's something out there that's putting some kind of pressure on Disney. And let me just glance at a chart real quick. Disney going into earnings, we are at 2 ATR away from a 21 EMA. We're also, let's see if I can show you what that looks like. So we just saw a big move, right, from about 160 to 190. So we saw a 30-point move, and we've just been chopping sideways last couple of days. Right, overall, I mean, the trend is up, but we're stalling here, and the market needs more catalyst for the next move. We can look to set up a trade in Disney. Let's see. In a similar trade setup where I'm looking to sell an out of the money call spread, and I want to cover my risk with a short naked put. And as long as the stock stays above, right? You see this? What color is this? Purple, right? This is blue with purple. Anyways, so the purple line is a 20-day moving average, which is also a middle band on the Bollinger Band. So as long as the price remains above this 20-point moving average, I think it's still a decent setup. I would want to be long Delta in Disney, which happens to be at 176. So if I can sell a 175 tomorrow is going for 75 cents, which is like nothing. Let's see. If I sell a 200, 202 and a half, which pays about 43 cents with about $2.07 of risk. I need to sell a put with about $2.10 worth of premium just to make it worthwhile. So that would be at 182 and a half. It's not a terrible looking trade setup, right? So we're neutral to bullish with no risk to the upside. To secure this trade, we would need to put up capital to sell a 182 half naked, which could be quite a bit, right? If you're doing this in a really small account. My downside break even is 182 half minus 2.5. So let's call that 180. So anything above 180 tomorrow is all good, right? Anything above 202 half, I make close to nothing. I make the most between 200 and the 182 half. I do have some slack room down to about 180. So from 180 to 182 half, depending on where the stock settles tomorrow. And then anything under 180 is a problem for me, or risk of owning stock at a cost base of 180. So if I was willing to hold stock long with a cost of 180, which on the chart, I mean, it's not terrible, right? We have just underneath previous resistance, which should act as support. We don't know that. It's not a terrible idea. And it's Disney. I mean, I don't want to say what could go wrong. A lot of things could go wrong, but it's Disney. me owning stock at 180, is that the worst that could possibly happen? I mean, I could own GameStop at 450. So I'll take Disney at 180 over that. All right, so that's another idea. I'm gonna write this down. So Disney, we're looking at selling 200, 202 half on the upside, and selling 182 half naked on the downside. Taking in about $2.55 or 260 with no risk to the upside. So those are the two ideas that I would consider. I'm going to look at. We're going to jump on a call with the group over at Active Trader. I think Anya is going to talk about some things, and I will go through a list of positions that I have for that group and my plan as to what I'm looking to do with it. Vasily's asking when it is. I think it is at 2 Eastern, 1 Central. So I think they are getting started now. So I'm going to hop off here. If you have any questions, you can post them in the group on Slack, and I will answer all of your questions. Thanks for tuning in. We'll talk to you next time.